Hello. Today we're looking at how mainstream economics explains prices. Prices are obviously a key phenomenon in any economy. Why do things cost what they cost? This has been a key question since the political economists in the 18th century. In a capitalist economy, supply and demand are reconciled in the market. Prices are a tool whereby supply and demand are made mutually consistent. The market has a coordination function, and through the market, goods and services are reallocated from the supplier to the consumer. Please note that I'm being vague here on purpose. I said that the market makes supply and demand mutually consistent, but I'm not defining what I mean by that. That's because I think it's actually quite a tricky problem. Mainstream economics does not share my caution. The answer how prices are determined is supposedly quite straightforward. The price on the market is the one that brings supply and demand into equilibrium. At that price, the amount supplied is equal to the amount demanded. Okay, that sounds reasonable. But what does that mean in reality? And in particular, how do we think of supply and demand? The workhorse of neoclassical economics is the supply and demand diagram. Supply and demand are lines in a graph that has price on the vertical axis and quantity on the horizontal axis. Demand is a downward sloping curve. As price increases, demanded quantity decreases. Supply is an upward sloping curve. As price increases, supplied quantity also increases. Let's look at demand first. As I said, demand is a downward sloping curve. This curve shows the assumed relationship between price and quantity caused by all the people that look to buy in the market. This demand curve is for a particular commodity and adds up all the demand of the different individuals in the economy. The demand curve is entirely hypothetical. It is supposed to show how much people want to buy at any particular price. The curve is sloping down because as price decreases, demand increases. That seems like a sensible assumption. If something's cheap, people buy more of it. One problem with this is that you can only be sure to derive such a nice curve, even within the mainstream approach, if you impose pretty stringent conditions on how people behave. Otherwise, the aggregate demand curve can have a very odd shape indeed. Supply is an upward sloping curve. This curve shows the assumed relationship between price and quantity caused by all the firms that look to sell in the market. The curve is sloping up because as price increases, allegedly supply increases. The idea is that if something's expensive, firms will want to sell more of it to make a higher profit. Again, that seems sensible. But the supply curve is only upward sloping if firms have decreasing returns to scale. That is, the unit costs of the commodity increases when more is produced. That seems counterintuitive. Why wouldn't one be able to produce twice as much at twice the cost or even a lower cost? Maybe it's true in the short run when capacity can't be increased easily. But in the long run, we'd probably expect the supply curve to be horizontal or even sloping down. So, what you're showing in the diagram crucially depends on the time frame in which the market is operating. Let's go back to the demand and supply diagram. Let's assume the price is higher than the equilibrium price. At that price, consumers want to consume less than suppliers want to sell. What happens? The answer you get in your university course is that the price is bid down. The suppliers bid down prices to get rid of their inventory and reduce their production until the equilibrium is established at a lower price. Sounds reasonable. One problem with this simple explanation is that what happens in one market affects all other markets. If firms reduce production, they reduce demand for their inputs, which has knock-on effects on those input markets, including the labor market and workers' incomes. If consumers increase their demand for this good when the price goes down, they might not buy as much elsewhere. So any adjustment here changes the whole system and has a feedback effect on the market you're looking at, which would shift the demand and supply curves back and forth. When looking at one market in isolation, as I have done here, this feedback problem is assumed away by economists by assuming everything else stays constant, called ceteris paribus in Latin. A different way economists try to deal with this adjustment problem is to assume that trades only happen when all markets in the economy are in equilibrium. This is achieved through a hypothetical process of tâtonnement, which translates into trial and error. Only once the equilibrium prices are determined in all markets are people and firms allowed to trade. You can indeed show that there is a general equilibrium in all markets if you put certain mathematical restrictions on supply and demand. However, even then, there might actually be many possible equilibria in theory. So mainstream economists do not really have a theory of how equilibrium in the economy is established. In effect, they assume away the problem. Then they assert that because there is an equilibrium in theory, there's also one in practice. But that theoretical equilibrium is not unique, so one cannot say that the economy definitely will tend to any particular price structure, even in the abstract model. Given that equilibrium is hard to establish in theory and to identify in practice, the question is whether it is an important or even a meaningful concept. The idea that the economy tends to equilibrium justifies the market economy as an economic system. It is supposed to imply that it is stable, prices are not random, and that the system is in a certain sense optimal. The problem is that neoclassical economics cannot prove the existence of unique equilibria that are attained in a stable process in either theory or in practice. It is not an adequate approach to explain economic reality. If we look at reality, we find that most prices tend to be pretty stable, but perhaps not those for raw materials or financial assets. So prices don't tend to jump around randomly. But that does not mean that there's an equilibrium in the neoclassical sense. If you think about the problem more deeply, you realize how difficult it is to even define a market in reality. Is the market for white eggs a different one from the one for brown eggs? Is the market for eggs different between different supermarkets if they sell eggs at a different price? Does the market cover today's and tomorrow's eggs, or are those different markets? Given that the economy is in constant flux, how do you define an equilibrium in reality? Are we only in equilibrium when prices and quantities stay the same all the time? Again, what's the time frame? How long do they need to stay constant to be able to say that there is an equilibrium? In neoclassical theory, you deal in abstracts, and these problems aren't even evident or discussed. But when you try to apply them in reality, you realize that the theory is not actually applicable. Mainstream economists effectively argue by analogy. Because it is true in theory, it is true in reality. The problem is that the theoretical concepts of market and equilibrium have no easily recognizable or definable counterpart in reality. The supply and demand diagram takes its place rightly at the center of mainstream economics. It is as much a great teaching tool as it is misleading. Demand and supply curves are entirely notional, and even theoretically, you need to make a lot of restrictive mathematical assumptions that can be economically nonsensical to make them have the right slopes and make the diagram look right. No market operates in isolation of all others. There's no convincing explanations of the dynamic that establishes equilibrium in the economy. The abstract markets and the concept of equilibrium in the theoretical model have no well-defined equivalents in reality and are pretty meaningless to explain it. There are many questions that mainstream theory leaves unanswered. but whether they need answering depends on your interests. Mainstream economics chooses to show that there is an equilibrium in abstract theoretical markets. Actually, there are many possible equilibria. And that's all it does. From my perspective, that's not terribly interesting, because I'm interested in understanding what's happening in reality. Thank you for watching.